Happy New Year. The market is starting to smell out the problems with the massive deficit. As you know, there's a committee called Department of Government Efficiency. It's an ad hoc committee that's going to be making recommendations to try to reduce this massive $2 trillion budget deficit the federal government has. We do not think that's going to be effective. The problems with the deficit we've outlined multiple times. Entitlements such as Social Security, Medicare, interest expense, defense spending, there's really not a lot of room for cuts. So with that occurring, the bond market, as we mentioned in our year-end piece, and we mentioned multiple times last year, is in danger of reaching a dysfunctional level. And as we are playing out over the past few months, this dysfunction seems to be taking place. So the Federal Reserve dropped interest rates by 0.5% in the middle of September. And the long-term Treasury was at 3.9% at that point in time, and has now moved up to 4.9%, up a full percentage points, as the federal funds rate has actually come down a percentage point. So we've seen the long end of the curve, which anticipates inflation, start to get very worried that inflation is going to be a big problem. And as inflation takes hold and goes higher, we believe that interest rates should also begin to move higher. Interest rates on the long end impact mortgage rates. Mortgage rates are up a full percentage point as well, up towards 7% from around 6%, back in the middle of September. So the Fed's last start of the cutting rates has actually been counterproductive to stimulating the economy and has only made people worry about inflation. Inflation numbers have come in hotter than anticipated. The Fed has actually increased its expectations for inflation for 2025 versus where they were 4 or 5 months ago. We think inflation is stubborn and likely to be with us on a longer term basis because this $2 trillion deficit that we're approaching is going to be very difficult to fix and is probably going to expand over time. So we think the federal deficit is going to drive higher inflation rates here in the U.S. and continue to be problematic. So the problem with bonds is clearly you do not want to be in longer term bonds. I would not own anything over 5 years. That's going to be a problem given where we're headed on inflation. And it's not on the impact on the price of the bonds go down as inflation goes up and interest rates go up. Your purchasing power of those bonds also erodes. So it's a double whammy. So bonds are very risky here and should be avoided. With regards to the stock market is a discounting mechanism on future profits, future cash flows, and earnings. So the higher the interest rate, the higher the discount rate that is necessary, implying a lower PE. So a interest rate on the longer part of the curve of around 5%, in our view, implies a PE that's reasonable around 20. We're currently a little over that, so we do think the market is a little overvalued versus the current interest rate. The problem is going to be if interest rates continue to move up, you would see a more severe correction in the stock market. If you recall, back in 1987, interest rates went from slightly over 6% to over 10% on the long end in about a 8-month period. And the stock market eventually cracked and had a pretty big correction in very short order, culminating in the 19% sell-off in the October crash. We are not predicting a crash, and the interest rates are nowhere that problematic currently, but we do advise keep an eye on interest rates. If interest rates continue to move up, the stock market will start to have more difficulty. We do think that over time, the only way we're going to be able to work our way out of this is through higher inflation. And as the Fed talks about, oh, inflation is under control, they want investors to buy the long part of the curve and be inflated away. At some point, the interest rates are going to get to high enough that the Federal Reserve, in our opinion, is going to step back in and start another round of quantitative easing. This is because the natural buyers of treasuries are going to be reluctant in a higher inflation environment to buy them anywhere near their current interest rate. And so if they want to keep it near current interest rate, it's going to be the Fed. The foreign governments have already started to back away from treasury purchases, replacing that largely with gold. There's even some talk of Bitcoin becoming a replacement for some countries, and that's actually taken place on a small basis. But just the fact that the US dollar, US treasuries have begun to have some real doubts across the globe means that interest rates could go higher and probably will go higher unless the Federal Reserve starts quantitative easing again. And when that happens, that will really hit the acceleration button on inflation. So stay cautious, keep an eye on interest rates. I hope you guys had great holidays. Please remember to take a look at our full disclosure on our website. And remember, this is not investment advice, but merely what we are doing with our own portfolios. Thank you for your time and have a great day.